Taher Badshah joins us, CIO Equities with Invesco Mutual Fund. Taher, good morning. Thank you for joining us. Okay, Taher, what is your sense? A lot has changed in last 3 months. Our markets,
good morning to you.
Markets pricing in, factoring in all the new, all the new adjustment, all the news development, whether it is on crude or whether it is fear of protectionism.
So at some level, I think so. Quite a lot of some of the irritating points for the market, irritants for the market have actually been have in some ways addressed, not fully addressed, but there is a certain amount of relief on a couple of these things. I think primarily our equity market, correction started on the back of the volatility and the weakness that we were witnessing in the debt markets earlier on, and equity markets, towards the earlier part of this quarter were actually on their own trip, whereas the debt markets were reasonably concerned, and with yields having gone up to as close to 8%. But I think we've seen that retraction from there. The debt markets have cooled down thanks to the RBI's guidance, plus the fact that inflation has remained under control, and also some of the government measures to deepen the liquidity in the debt markets. So I think markets, the key fear for the markets, which was essentially in the form of interest rates, has actually kind of recoiled, and therefore the correction which has come about as a result has kind of more or less factored that in. The other thing was, of course, trade wars. We also now realize that this is not something which immediately affects us. We are not in the crossfire as yet, and probably things are cooling down between the US and China as well, although we don't really have a great view on that, but given whatever is circulating in the press, it appears that things are kind of more on a reconciliatory mode as far as the two of them go. So I think the key irritants are actually kind of behind us. Meanwhile, the markets have corrected, individual mid caps, etc., have corrected as a basket even more so, and therefore I would think that we've seen that bit of correction behind us, and hopefully we should kind of trend upwards on a gradual basis.
Taher, so what's looking interesting in the market to you right now? As we're on the brink of earnings, you'll have Infi deliver its numbers. Do you get the sense that this quarter too, it may be a very muted earnings performance, or do you think an earnings recovery is finally imminent with 4Q?
Are you referring to IT or in general?
No, just in general. What is it that you're expecting from earnings at large?
All right. Yeah. So I think what we've seen being put out by many of the houses, at least in terms of consolidated earnings outlooks for this quarter, don't seem to indicate a significant departure in trend from what it was in the previous quarter. So I think it will be reasonably fine, reasonably strong, as good as the last quarter, at least in terms of the headline numbers for the basket of Nifty stocks, or maybe the top 100 stocks in the market. We're looking at numbers anywhere close to between 10 to 13-14% as the likely growth number over the previous year for the Nifty as a whole, which is a reasonably decent number to end the year with, and it will set the tone for probably better earnings growth in the subsequent quarters. So I think delivery is likely going to be in a way, even if you were to break it sector wise, it is probably going to be in the same manner. We'll see cyclicals, commodities, industrials contribute from the point of view of the base effect. We will see autos being reasonably strong as such, private banks also contributing their bit. Not much can be said out of the PSU banks, but at least the hit which was likely on account of investment related hit is probably going to not come about, given that March 31st the yields have ended at more or less the same level as where it was in the previous quarter. So I think FMCG, etc., probably pharma are going to kind of maintain the same trend as what we saw in the last 2-3 quarters. So broadly, this is going to be the kind of big picture as far as the earnings season goes. But it'll even if it is in line with what it was in the previous quarter, then I think it'll be a step up, incremental positive, and should set the tone, as I said, for the year ahead in terms of better earnings growth compared to FY18 and probably the last couple of years as well.
This time, for some very specific and miraculous, if I may say, reason, we do outperform on the earnings side, or better perform better than market expectations. But Taher, I want to go through some of your funds, and particularly I think the Contra Fund draws my interest. The 1 year, 3 year, 5 year returns have been impressive. But what I see as part of the top holdings, in this fund are an HDFC Bank, an HDFC, a Reliance Industries, Infosys, and ICICI Bank. I can understand the contra view on ICICI as well as Infosys. What about the other three names? Because how do you qualify contra and invest in this fund, through this fund rather?
Sure. So that's an interesting question, and actually, so among the top 5, as you mentioned, that there are 2-3 names which are, of course, not the best or not the most sought after names in the market today. But there are a couple of names which have been around in this portfolio as well, which are kind of not contra names, contra in the strictest sense of the term. But basically, I think HDFC came in about a couple of months earlier when it was to us the starting point in the contra fund is always relative inexpensiveness of valuations, either with respect to intrinsic value or with respect to likely growth over the next couple of years. And to that extent, HDFC Limited at least appeared to have turned attractive simply because it was trading at valuations which were relatively cheaper compared to its historic average, plus the expectation that growth going forward would get better compared to what it was in the last 2-3 years, especially after their capital raise. So it's not only about buying something which is totally beaten down, but sometimes you also buy things which are a growth but at reasonable price or well below reasonable price. I think HDFC Bank is a old holding. It happens to be among the larger picks simply because we do not buy any underweight positions in our portfolio in any of the names that we have. But it came about at a time when valuations of HDFC Bank had actually kind of come off relative to the historics, especially at the time when we were seeing the FII premium being significantly higher on account of the FII limits which were available, which were imposed at that point in time and yet continue. So I think that's what explains HDFC Bank and HDFC Limited in the portfolio. But our point of view and our key premise in the contra fund is not to focus as much on the top picks, but to focus more on the names which are actually overweight compared to the benchmark. And while you may not have that data in front of you, but we have close to about 10 stocks which account for about 25% of the portfolio, which today do not have as much of weight in the benchmark. The benchmark weight across those 10 stocks would be barely about 5%. So we are about 20% overweight in some of those names, and that is what our alpha engine, if you wish to call it, will be for the contra fund. So that's what we would like to focus on. Those are the names which we are in a way overweight the benchmark, and that's what will generate our alpha going forward for the fund. So that's how we position this fund. That's how we look at this the approach in this fund.
Okay, so thanks very much for clarifying your investment strategy with regards to managing the contra fund. Give us your own sense on how you would be viewing what's happening with the banking sector right now and your own exposure to the sector. Have you changed it over the course of the last 1 month? What have been your, what has been your stance really on the space and the names which are being talked about, ICICI Bank and Axis Bank, both of which are holdings for you?
Yes, so there has been a bit of an incremental shift in stance, and it's not happened over the last 2 or 3 months. I would think it has probably been the case for the last almost 4 to 6 months that we have kind of tried to look at some of the so-called corporate-oriented banks. But we have looked at those names where we believe that the overall banking franchise is reasonably strong, and where the core business of either corporate or retail banking, more particularly retail banking, has actually not been affected in the last 2-3 years, despite the despite the asset quality stress problem in some of these names. So we've looked at those where either the core lending, in terms of consumer lending business having been reasonably strong, probably NIMs have been reasonably strong, or maybe companies where CASA is still at the very highs of 35-40% types, or the banks which are decently and adequately capitalized, and probably do not have any immediate need for capital. So we've looked at those franchises, and we've tried to see if there is a possibility that earnings could gradually significantly recover if the asset quality stress problem is taken away. So this is what has guided our selection of some of these banks where there has been a value proposition. Valuations in the meanwhile have come off quite meaningfully compared to their past, and with relation to their guided ROEs for the near future. So I think that's what has incrementally guided our inclusions of a couple of the names that you mentioned, ICICI, Axis. It does figure in the Contra fund. It figures in a few other funds as well. So that's been our incremental positioning. Core positioning still remains significantly veered towards some of these private sector names where we have not really changed as much. But some of these value opportunities have emerged for us a very, very selective basis. We know the challenges which are which affect this sector. So that's what has guided us, that we don't want to compromise on the core banking franchise, and yet if we have a problem with respect to asset quality which we can tide over, then that's something which probably attracts us.
But does it make sense to be a contra investor and a value treasure hunter in this kind of a market? Because frankly, if you look at the last 3 or 4 years of market orientation, too much of contra approach has not made money. Let me give you some examples here. Instead of corporate banks, if you bought retail banks, which was a crowded trade, it has made money. For those who acknowledge the fact that consumers are expensive and yet growing, they've made the best returns. Similarly, for those who went contra, bought wholesale banks or stroke corporate banks, they went into pharma. Those contra trades have really not made money. I mean, last 2 or 3 years has been all about these crowded trades, and those crowded trades are still outperforming.
So at one level I agree with you. I also don't agree with you at one level. So in the sense that contra from a sector standpoint, we have not really found as many opportunities in the last 1 year. We have found more contra opportunities from on a bottom-up basis. The last clear sector kind of contra call that we were able to identify, and which we played very well in the contra fund, was IT. 1 year ago, when we went significantly overweight in this sector in the contra fund, and what has happened to IT since then in the last 1 year. So our premise has been that we would like to buy contra. This is the mandate of the fund. So obviously we're looking for contra stroke value stroke inexpensive valuations, that kind of an opportunity in this fund. But we are cognizant of the fact that we don't really want to take undue risks. So we try to assess at our end in terms of what is the downside. Can we live with 10-15% downside? Yes. But are we exposing ourselves in this fund to things where we could fall into value traps? We don't really want to get into that. So we are choosy, we are picky about stocks. We don't really find as many sector opportunities. Maybe the more recent sector opportunity, if at all you were to call it, is what we recently discussed, which is some parts of the corporate banking space. So that could turn out to be a contra opportunity. For example, pharma, on the other hand, we've not really been overweight. Despite the fact that there is a fair amount of stress and distress in that sector, we've not really been overweight that sector. We have a couple of stocks in our portfolio, but those are again bottom-up picks where we believe that the downside is significantly limited and the exposures to some of the common problems of pharma are not seen in some of these companies. So I would think that that is how we approach our contra strategy. And last but not the least, the fact that Invesco Contra Fund has actually been among the top 4-5 performers in the last 1 year, despite having followed a contra strategy, kind of tells you that it is possible to make money in a contra fund, in a contra strategy.
Finally, Taher, we going to kickstart the IT earnings from today, and I recall that you went overweight on IT in your contra fund last year. Given how fabulous the price performance has been for IT sector per se, what are you expecting in terms of earnings? Do you think earnings can match up the kind of price action we've seen on the stocks?
Well, we'll wait to see, but as to how it unfolds as we come over the next few days in terms of the results. But the starting point is still not significantly higher earnings, and it is still earnings which can unfold over the next 2-3 quarters. Maybe not still this quarter. Most estimates still point to between 8 to 12% in case of INR top line growth year on year, which is which is probably not substantially different from what it has been in the last few quarters. So we don't expect a significant acceleration in the earnings trajectory, but the numbers could follow a little later. But some of the signs in terms of the digitization effort of the last 2-3 years having kind of gained some scale, with many of the companies now having crossed that 25-30% barrier, having spent decent amount of time in this space, running projects in the digital segment. They will come up to a certain level of maturity. They will come up to a stage where bid sizes will actually start going up. There could be a possibility that down the course of the year we might probably see the S&P 500 companies actually starting to increase their IT budgets, and that allowing for the space itself to expand going forward. So those possibilities remain. This is a year also when the rupee has not really given any kind of tailwind. So maybe there is a possibility that might give some tailwind in the current year. So there are certain drivers which are gradually surfacing. Now we need to see how they unfold. Right now we are not significantly banking on a dramatic change in earnings trajectory.
Okay, Taher, great speaking with you. Thanks so much for taking the time out and chatting about your take on the markets, what you are expecting from the earnings as well this time. Let's focus on what Titan is up to, and they aim to grow their jewelry business by 2.5 times. That's what they've done in FY17, and they're saying that the revenue by FY23 now versus the previous estimate of FY22. They're aiming at uniform consumer price revenue of 50,000 crore rupees by FY23. I don't know where Titan would be speaking, and considering that they should be in their silent period, they're giving out way too many details. But again, this is a very long drawn projection that they're talking about.
Yeah, I mean 2022 is not this quarter, last quarter. It is like some 3 years away. But the fact that they expect the business to be substantially higher, which means, for Titan the mainstay is the jewelry business and the spreads which they make. But if you expect the business to, let's say, become 2.5 times in 5 years, which means you are expecting a growth rate of about 30% plus. Because if you are doubling the business in 2.5 years, which means you're expecting at least a 30% plus growth rate. Here they are looking at making the business 2.5 times in about 5 years. So that's a sizable, bullish comment which is coming from Titan. And Titan belongs to Tatas. They are not known for giving very topsy-turvy, outlandish kind of, guidance.
Outlooks,
But it's a pure, simple play on unorganized sector moving to the organized sector. Whom will you trust? The jeweler, the family jeweler, or a gold or a piece of jewelry which has a buyback guarantee and there has a stamp of authenticity which is coming from the Tatas. I think it's a pure play on that. It's a pure play on better customer experience, better design, better trendy stuff, and they're cutting across all ranges now. I mean, Smriti tells me that Titan jewelry is starting from 25,000
There's
to 20
affordable
lakhs.
stuff
Exactly.
too. It's not only about those heavy-duty gold pieces. Okay, we're going to take a very quick break. Titan, of course, is shining bright right now, and